I'm Duncan McDonald-Korth, and I'm reporting you today from Oxford, England. I'm the editor of the OxWFD, and this is part of our new video weekly recap series, where I'll cover the top stories of the week and let you know our opinion on them. So needless to say, this is a big week to start the recap, because it was one of the most eventful trading weeks in recent years. Markets started plunging last Friday, but the sharpest sell-off came on Black Monday this week, when shares in Asia started down 8.5% in China and then proceeded across the globe to fall very steeply. U.S. indices entered a correction, with some stocks like Apple entering an outright bear market. However, over the course of the week, all of this reversed, and by the end of trading on Thursday, the market had actually reached a higher level than where it closed last Friday. Emerging markets were also hammered, with currencies weakening strongly and heavy capital outflows. Alongside all the volatility in equity markets, it's no surprise that oil had a very topsy-turvy week as well. U.S. oil dropped as far as $37.75 a barrel this week, but then reversed course strongly yesterday, rising 10.3% in a single day, mostly on news of rising equity markets, stronger U.S. GDP, and 2 outages at Nigerian pipelines. Finally, on Thursday, the U.S. Commerce Department also released its GDP revisions for the U.S. in the second quarter. The revisions were a doozy, with overall growth rising to 3.7% from 2.3%, the initial estimate. However, part of this jump was due to a rise in inventories, which is a potential point of weakness. Additionally, gross national income, which is an alternative measure to calculating growth, came in very weak at just 0.6%, which is something to bear in mind if you're looking at the U.S. economic forecast. So, what to make of all this? Firstly, on oil. We have a strong opinion on oil. We think the 10+% rally yesterday was completely overblown. Most of this came alongside rising equity markets, stronger U.S. GDP report, and news of outages at 2 Nigerian pipelines. However, in our view, nothing in the fundamental supply-demand situation has changed, and therefore we expect prices to revert to the mean, where they were last week. Now on to markets as a whole. In our opinion, it is a particularly difficult time to give a market outlook, and this is because we think that markets moved this week largely on intangible problems. Much of the sell-off was centered around the idea of a slowing economy in China, but there's little concrete evidence to prove that the Chinese economy is actually slowing. Perhaps the most worrying thing this week was the desperation with which China responded to its falling equity market. The desperation shown by the Chinese government over the last several weeks ultimately ended in failure, as they quit trying to bail out the market this week, which prompted the heavy falls. In our opinion, this desperation signals that the Chinese government has lost control of the economy and markets there, which is a change of paradigm from recent years. We believe this weighed heavy on global investors because the future is quite unclear. So in terms of where markets are headed, OxWFD's opinion is that volatility will continue, even on possibly minor news. So stay alert and look out for what's happening. Thanks for visiting, and make sure to see us next week.